Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. This is the third in a special series with Trends with Benefits covering Bitcoin. It's our No Jargon Bitcoin series. And today we want to tackle how Bitcoin is traded. And to do that, we invited our special guest, Ari Paul, CIO of BlockTower Capital. Ari, thank you very much.
Thank you for having me.
Now, looking at your background, you come up the traditional finance route into Bitcoin and blockchain. Is that right?
Yeah, I'm non-technical. Not a computer scientist or a cryptographer. I have a financial background. I was a market maker and prop trader at Susquehanna International Group, and then an allocator, portfolio manager at the University of Chicago $8 billion endowment. So very much, basically the spectrum of traditional finance, short-term trading, market making, prop trading, and then long-term capital allocation.
Now you have a PDF out there on your LinkedIn that it's a presentation about blockchain. I think you did in 2017. Is that when you really caught the Bitcoin bug, or was it a little earlier than that?
It was definitely a gradual for me, and so I can empathize with people who took a while to kind of get it or are still in the process of getting it. I searched, after launching BlockTower in 2017, I searched my email for the first ever reference to Bitcoin. I was just curious, when did I first mention this? And a really smart friend of mine, who's actually a bond trader at PIMCO, sent me an email in 2011, forwarding a New York Times article on Bitcoin, saying this looks interesting. And my response at the time in 2011, which I didn't remember sending, was crypto will never have value because value comes from either historical long-term appreciation of value like gold or fiat backed by guns. That was my definitive dismissal of cryptocurrency in 2011. I bought my first Bitcoin around mid-2014. And at the time, I was not a passionate believer. I didn't fully understand it. It was dipping my toes in. And the angle that actually got me interested at that point was I had fairly recently read, I think it was Alchemy of Finance by George Soros. And he's a big proponent of kind of this model of bubbles. That's an extension of the work of Martin Minsky. And the idea is that basically when a smart investor should invest in something from a bubble perspective is basically when it should die but doesn't. So in early 2014, we were just coming out of the Mt. Gox exchange failure, which was more than 5% of all Bitcoin in existence were stolen from an exchange, and the closing down of Silk Road, which was kind of the single clear use case for Bitcoin. It was a darknet market for, call it an illegal eBay. And so the biggest exchange, the biggest use case, both shut down, failed. And yet it didn't die. There was clearly there was still interest. There were still people passionate in the community building. There was still a bid. It sold off a lot. It had hit a peak of over 1,300 at the end of 2013. It was down to $400, but there was a clear bid. And I thought, I put on my George Soros hat. I'm like, okay, this easily could have killed the asset. It didn't die. Why not? That's interesting. And so I bought a little bit and then really spent 2.5 years gradually falling down the rabbit hole, gradually learning. I didn't really have conviction until I had enough knowledge in all of the individual components, until I understood the game theory behind proof of work consensus a little bit of the computer science, a little bit of the cryptography. And at that point, I was able to kind of put this puzzle together and say, I'm convicted this is a great asymmetric bet. Doesn't mean I know that it's going to win, but and that was kind of the end of 2016. I got to this point of conviction that this is the best asymmetric trade I've seen in my lifetime. That yes, it could go to zero. There's lots of risks. I could write pages and pages on the risk factors, but I see a clear path to 100x return. We're actually almost there. My original thesis in late 2016, Bitcoin was at, call it $1,000. We've actually almost gotten 100x already. At some point today, I'm sure we'll discuss kind of, well, what is the future, right? Is there another 100x ahead? But I'll pause there.
Yeah, no, let's keep going. Where we're at the levels that we're at now, and we'll get into talking about how to trade it, but just kind of curious your opinion. At levels that we're at now, would you make the same bet on Bitcoin that you did back then?
It's certainly not the same in that I think this is, to use a VC analogy, maybe late 2016 was kind of like a Series A or Series B, whereas now we're at closer to like the Series F or even like, maybe we're post-IPO at this point. And so the asymmetry is different in that the asset has been de-risked to a large degree, in that we now have basically total regulatory clarity on Bitcoin, not on all crypto assets, but on Bitcoin. We now have regulated custodians. We have white shoe law firms and accounting firms and auditing firms that know and understand crypto. We have the beginnings of prime brokerage. We have operational infrastructure that supports a modern crypto trading firm, for example. We don't yet really have a Bloomberg for crypto, but we have a lot of people vying for that seat. So much more transparent information, easier analysis, and of course, adoption. So, we have companies like Tesla and Square and MicroStrategy with Bitcoin on their balance sheet. We have Coinbase about to IPO at probably over a 50 billion valuation. So in some respects, it's a much better investment in that it's been de-risked. Not to say there's no risk, there's a lot of risk, but it's a much more mature asset. But on the other hand, the upside is certainly less than it was before it did this recent 60x. And so we do kind of have to ask the question of, well, what is the upside? In 2016, when people were debating, is the upside here a 10 trillion asset or a 200 trillion asset? I'm like, I don't care. I'll worry about that after it does its first 100x, right? I'll have a lot more information in a few years, and then after it does the 100x, I can think about that. Well, now I kind of have to think about it. My own view is that there's kind of two success cases at a difference of an order of magnitude. The first is Bitcoin at something like, call it 10 to 30 trillion in market cap. That would be success as digital gold. So gold, I actually don't know at the moment what its market cap is, but I don't know, call it about 8 trillion, maybe slightly less given the recent sell-off. Bitcoin is objectively, I think, a much, much, much better form of gold, much more accessible and usable, programmable, more secure, more auditable. So I think it's very likely, if it succeeds in playing the same role as gold, to be some multiple of gold. So call that 10 to 30 trillion. There's also an element of the offshore banking services system as an analogy, which is seizureship resistance. So that's kind of level one. And that Bitcoin currently is close to a $1 trillion asset. So there we're looking at kind of a 10 to 30x in that success case. And then the higher tier is, could Bitcoin become a global store of value being used as money in at least some places? I actually think my view is that's unlikely. It's possible, but unlikely. And I think it's unlikely because governments will never voluntarily give up seigniorage rights. The best thing in the world as a government is to be able to print your own currency, as really anyone. So the only countries in history that have ever given up that right it's never, ever been voluntary. It's always been, you have countries like Ecuador that peg to the dollar because their own citizens lost confidence in the currency and the currency collapsed. And so their only option was to do something radical like pegging to the dollar. And then, you have other countries where similarly the currency completely fails and they're forced to use greenbacks, US dollars as default currency or something else. But no country voluntarily gives up that right. And so I think it's very unlikely that, all fiat globally is going to completely fail and Bitcoin just takes over. A more likely tier 2 success case in my mind is a meaningful percentage of the world has failed fiat. So, we see it in places like North Korea and Iran and Venezuela, and to a lesser degree, even Argentina, where average citizens transact somewhat or try to store their wealth somewhat in dollars. But I don't think it takes over. I think you're going to have some successful fiat currencies in 20 years. So that tier 2 success case is maybe call it 70 to 100 trillion, where it's kind of in the pantheon of serious global reserve currencies alongside maybe the dollar and the yuan and the yen.
That's interesting. You talked about it as a potential store of value, and institutions that we've spoken to look at Bitcoin in a couple different ways, either as a store of value or a technology. Do you lean one way or the other on that view and how to look at it?
So it's useful to distinguish the Bitcoin technology, the protocol, from the financial asset. And 3 years ago, they were kind of the same thing in the sense that Bitcoin, the financial asset, only existed on the Bitcoin protocol. You could kind of think of them together. And it's actually unfortunate that the word is the same, right? It's Bitcoin, the protocol, Bitcoin, the currency. For Ethereum, you have two different words. You have the Ethereum network and you have ETH, the asset. And that's great because it naturally leads to a distinction. What's happening now, literally right now, is we're entering a world of interoperability. And what that means is, I realize the title of this is no jargon, so apologies. I'm going to try to just talk in plain language. All that means is the ability to move assets across protocols. So if we use the US dollar as an analogy, owning US dollars doesn't mean on a particular protocol. If you say you have US dollars, you might have physical cash. You might have US dollars sitting in a centralized walled garden like PayPal or Venmo. You may have it as a checking account, or you may have it as a central bank reserve. So we understand that US dollar is a financial asset that can exist in kind of different forms within different walled gardens on different protocols with different features. So the US dollar at scale shuts down. It's shut down most of the time. On weekends and at night, you can't transfer $10 million, right? How would you do it? The SWIFT system's closed, the ACH system's closed, but PayPal's 24/7, Venmo's 24/7. That's not an enterprise solution, but the point is that you can get different features on your US dollar depending on which protocol you're transferring it over or storing it on. So we're now entering that same world with cryptocurrency. Bitcoin exists as a financial asset on Ethereum. What people have done is they've taken Bitcoin, they've custodied it with a trust or a bank, they've issued a token on Ethereum that is wrapped Bitcoin that is redeemable for Bitcoin held with a regulated trust. So that Bitcoin on Ethereum now has access to all the features of the Ethereum protocol. The Bitcoin protocol is frankly obsolete. It's a static, ossified, basically unchanging protocol. And it's already out of date. It was out of date the day it launched. But any features that you want with novel technology you want to make use of with Bitcoin, you can via moving Bitcoin onto these other protocols.
Let's dial it back a little bit and talk a little bit about your firm, BlockTower Capital. Tell me a little bit about your firm and what your mission is.
Sure. So we are a asset management firm. Our mission from day one was to apply the skill sets of professional investing and trading as practiced by the industry leaders in traditional finance, top asset managers, top hedge funds, top VC firms, and to apply that to cryptocurrency. And the basic challenge is cryptocurrency, especially in 2017, but absolutely still today, it's a small pool. It's basically, we get to be big fish in a small pond. It's a small pond in the sense that almost all of the capital is not managed by professionals. We don't view ourselves as competing against other funds or other professionals because all the professionals in cryptocurrency combined probably manage 5% of the assets. That is totally reversed from traditional finance, right? In traditional equity markets, the average trade is done by a quant algo. The second most likely is done by a professional market maker or discretionary trader. Distant third is kind of the dumb money that you're hoping to make money off of. So in cryptocurrency, we are trying to profit from retail flows, institutional flows. We really do everything. We're very active in Bitcoin and Ethereum options trading, which is a fairly liquid market now. At any given time today, there's about $10 billion of open interest in Bitcoin options, and that's fast growing. We do VC style investing in early stage startups where I'll say that is a relatively competitive space. The top VC funds in the country, guys like A16Z, Sequoia, they're in crypto and they've been in crypto for more than 5 years at this point. So you do have the best and brightest VC talent looking at crypto. But on the trading side, Citadel's not in the game, Two Sigma, Rentec, none of the heavy hitters are in the game, and they won't be for a few years. Now, let me clarify that. A lot of the big institutional, the top hedge fund brands in the world, some of them are starting to trade Bitcoin, but most of them only trade CME Bitcoin futures. They're handcuffing themselves. CME Bitcoin futures are a relatively small percentage of the market, of the liquidity, and they don't trade on weekends or at night. Well, actually, I'm not sure I need to check on the trading hours, but they're certainly shut down on the weekends. So they're trading an asset that trades 24/7 via a vehicle that only gives them a small sliver of liquidity and that is shut down much of the time. And that's one asset. The cryptocurrency space, we trade more than 100 liquid cryptocurrencies. And there's actually hundreds to trade. As you get into smaller cap, of course, liquidity becomes a bigger challenge. So this is an industry where it's a very gradual path to adoption by professionals for very reasonable reasons. It's not that Citadel doesn't get that there's value here. It's that everything in crypto is hard. The security side, right? Trying to run a trading shop and having secure custody and having the authorizations and the controls around your trading employees that you would expect at a traditional shop. It can be done today in crypto, but it's very difficult and it requires solving novel problems that a firm, that traditional hedge funds are just not familiar with. To figure out how we were going to custody assets, it was a 6-month project involving more than 100 hours of me personally researching the cryptography, the engineering, and the social engineering side to see which custodians do we trust. That's not something you normally do in the traditional world, right? You just trust State Street. No one diligences State Street. It's State Street. In crypto, we diligenced Fidelity. We diligenced the competitors to Fidelity because it's not just, is this a reputable firm? You have to be worried about the actual cryptographic implementations of relatively novel cryptography. So all of these obstacles are headache-inducing, they're challenges, and they're gradually being solved. Gradually, crypto is starting to look more and more like, using the custody example, it's not that everyone should blindly trust State Street. It's that we do and we can because it's been operating in the same way for so long. Similarly, how many investors actually diligence the Swift network? It's not that Swift is so cutting edge and robust and tested and bug free. It's more just we trust it. We trust the legal system. We trust that everyone's using it, so we're okay to use it. So in crypto, we're going to get there over the next 5 to 10 years. Cryptocurrency, my guess is in 10 years, cryptocurrency basically looks and feels like a modern traditional market. And at that point, a lot of the alpha will be gone, right? Because all the world's top professionals will have, the $1 trillion of capital chasing the same set of opportunities.
What are some of the different ways that institutions would acquire Bitcoin or trade Bitcoin?
So that's relatively easy today. The two most common paths of U.S. institutions in the last 6 months have been Coinbase and Fidelity. Both operate OTC white glove service, where you can go to either of them and say, hey, I want to buy $1 billion of Bitcoin, and they'll talk with you about, do you want to buy that in a day, in a week? We can do a TWAP program. We can give you a risk pricing. There are plenty of other OTC desks that are U.S.-based, regulated, trustworthy. Cumberland, my former employer, SIG, I believe, still operates a Bitcoin OTC desk. Genesis, Galaxy, these are all entities that we face as a counterparty that we've had good experiences with. So it's basically it's reach out to any of those names that I mentioned. They're all U.S. regulated, trustworthy as entities. I say trustworthy as entities, and the subtext there is still counterparty risk that's operational. If they face an operational failure, an insider theft, a hack, there is still risk there. But you have a UX, an experience that is going to be very similar to working with a traditional OTC desk.
Now, if one's going to an exchange, maybe we can break this down real simply. What's the difference between, say, a traditional stock exchange and a cryptocurrency exchange?
I think a few differences. One is the counterparty risk. The crypto exchanges are best thought of as, at best, late-stage startups. So Coinbase is an example. They're about to do an IPO, estimated to be priced at $50 to $100 billion. So obviously that's not a seed stage company, but they are still a startup, and they're not the NYSE. They have very, very limited insurance that I personally wouldn't trust without closely reviewing the insurance contract and understanding exactly what the insurance company is committing to cover. These are regulated institutions. They're US based. They are very trustworthy in that sense that, they fall under US legal regulations and are suable in court if anything goes wrong. So the risk you're taking there is really that no one's going to get away with stealing stock certificates, right? On the New York Stock Exchange, actually, I can frame this in prime brokerage terms. So when you're trading on the NYSE doesn't have custody of your equity. There's no risk that a NYSE employee is going to walk away with your Microsoft stock, right? You have this whole system of clearing firms and the U.S. Stock Certificate Corporation and, this whole kind of crazy convoluted Rube Goldberg that we use to manage the equity world. And for practical reasons, we trust it, and we should. I'm not implying there's anything untrustworthy about it. With Coinbase, if you're trading on their exchange, they're acting as custodian of your assets. You are trusting them as a counterparty. That probably won't be true in 3 years. So the industry is very hard at work at building out prime brokerage and clearing solutions, but they don't really exist yet.
And what other considerations would you advise somebody looking at beginning trading in Bitcoin and looking at different exchanges or platforms to consider?
So depending on your size, liquidity is, if you're trying to do $1 billion of a Bitcoin buy, that's hard in today's market. You're definitely, if you were trying to do it in an hour, you would face very meaningful slippage, probably 5 to 10%. If you're trying to do it over a week, slippage is much closer to zero. Hard to measure, of course, because it's such a volatile asset. You can't really do great studies on this, but so just being conscious of that and working closely with an OTC desk to create an execution plan. If you want to buy $100 million, that's much easier. $100 million you can probably do basically in an hour with risk. An OTC desk will probably quote you that maybe 3% over market. 3%, of course, sounds like a huge amount of slippage, but in the context of, Bitcoin is up very roughly 900% in the last year, something like that. So 3% is not that much in the context of, and of course, there's volatility to the downside, right? We've had days where it's down 10% and more. If you're an institution, you need to have reporting and auditing and accounting and all of that stuff. So talk to service providers. All of the white shoe firms today and basically every industry serve crypto. So on the account, KPMG is eager to take your crypto business. All of the top law firms, most of the top auditing firms are in the game. They're eager for crypto business, but it may make sense to talk to them before acquiring Bitcoin and just make sure you have the controls or the reporting in place such that you're not going to be chasing after Coinbase in a year trying to get the data you need. I think that's it. These are exchanges very familiar. Any trader, they look like a normal exchange. Nothing novel.
So if you're a large enough institution or moving a large amount of Bitcoin or cryptocurrency, you're probably more likely to use an OTC broker than trade on the individual exchanges.
I mean, if you're not like a trader, if you're a family office that's not, day trading, I mean, the only way, so either you run your own TWAP type algo, if you have your own execution software, or you do it manually, which requires basically a full-time execution trader, or you outsource that work to an OTC desk. The OTC desks today are very professional. It's people like Jump Trading, people like DRW. It's the top OTC market makers in traditional markets are just doing the same in Bitcoin. They have access to global liquidity. They have quality algorithms for execution. So there's kind of no reason to do it yourself. You get pretty good price. Like I'll tell you, like we have our own algos, we have our own execution traders. We still frequently trade with OTC desks because often, I mean, they'll have a 30-person execution team and they're onboarded with every source of liquidity on the planet and they're seeing flow. Sometimes they can get us a better price than we can get ourselves, even though we're well equipped to execute ourselves.
Now you talked about the custody changing pretty rapidly, but until that really does and people are able to custody elsewhere, should institutions have concerns about custodying their assets at exchanges?
Yes. So if Coinbase goes bankrupt today, most likely the people holding assets there lose their assets. You're just a creditor to Coinbase as someone with assets at Coinbase. The caveat there is they do have some insurance, but again, a person at least, I would discount that unless you've had your legal team review the insurance contract and understand exactly what's covered, because no insurance contract offers blanket coverage, right? There's always carve outs for if the loss happens due to A, B, or C, this is not covered. So from my perspective, I kind of assume that these are all uninsured entities with exceptions. Specific forms of loss may be insured against, but not general loss. So you should be wary. I would say that one of the biggest still existing concerns in crypto today is custody. You do have a number of trustworthy regulated custodians in the industry. The two that I would personally recommend that I have to varying degrees diligenced are Fidelity and Anchorage. Anchor Labs is a US regulated custodian that we use. Both are doing great implementations on, I think of custody from three angles if you're actually diligencing it. There's the engineering side or the physical hardware, there's the software, and then there's the social engineering, there's the process side. The process side is probably the most important in that however good your hardware and software, if there's a this is a little more in the weeds, so I'll just leave this at one sentence, but as I was personally diligencing custodians, the question that was kind of my litmus test as the single hardest bar to pass was how many people at this firm would need to be compromised internally for assets to be lost. And the first answer every custodian gives is like 20, right? They have all sorts of controls. But if you really dig in, it's never more than 4 people. And that's true, by the way, for State Street, because you always have someone running security. You have someone who actually puts the security system in place. And there's just no way for that to be 20 people as checks and controls on that. If it's 4, I'm very happy. 4 people is actually like great if that's the answer. Usually the answer ends up being less if you really dig in.
And do you do anything to protect against that, or just even with that 4 person seems like a small amount?
Yeah, well, the reality is that in traditional finance, it's usually fewer. So for all the risk controls and management and risk team that takes place at a trading shop, I mean, we hear every few years about a massive trading shop blowing up due to a rogue trader. And all of those shops have risk management and controls and back office and stuff like that. But the reality is it's like, okay, you've got your risk management team, but if that guy has his password on a Post-it note on his computer, or if that person can be bribed, or if the person who's setting up security can be compromised, maybe they put in place a complex system of checks and balances. But if someone gets basically root access to the system and can install hardware loggers, and I don't mean to get very technical here, but this is going to get better over time, largely for the same reason we trust Swift and we trust State Street, which is it's proven to work empirically. It's like when I get in the car, I don't need to be an expert on internal combustion engines. I'm pretty confident that I see everyone driving and cars aren't blowing up that often, so I have comfort. Realistically, that's where comfort comes from. That's the nature of brand. We trust strong financial brands because they've been around for 50 plus years. So the same is true here, where basically every year that Bitcoin works, we have confidence that there's no bug in Bitcoin, right? It's now a $1 trillion honeypot. The fact that hackers have not been able to exploit it for more than 11 years now gives us conviction, more than a code review can. right? We can review the code all we want and think it's bug free. The proof is in the pudding. And the reality is you've got $1 trillion network that no one's been able to compromise. The same is true on the custody side. Every year that Fidelity operates, that Anchor Labs operates without having a loss, we're going to gain increased empirical confidence in that, as we should. And you're going to have better transparency, better auditing. All of these custodians are going through SOC 2 audits. They're being audited by the top auditing firms. That process will become more robust, more trusted. We'll get more familiar with it over time. So part of this is just psychological. It's gaining confidence over time in a complex system. Part of it is best practices will continue improving. The technology side on the cryptography itself is evolving very quickly, faster than it ever has, because now you have this immense commercial money. Like cryptography used to be basically academics and defense departments. There was no commercial money behind it. There were no commercial applications. Now it's $1 trillion industry. Now the world's best. Now people are studying cryptography as undergrads because it's $1 million a year job fresh out of undergrad, because there's such demand for it. And among, Fidelity is looking to hire top cryptographers. So every aspect of it will improve over time. But the answer for us is diversification. So we effectively custody our assets across numerous different platforms because there is idiosyncratic risk and we do get a diversification benefit.
Do you trade in Asia at all? I mean, there's more liquidity, there's a lot of liquidity in Asia, isn't there?
Yes. So this is a tricky answer. Most foreign exchanges ban U.S. customers because they don't want to deal with the SEC or CFTC regulation. It's just extremely expensive to be a regulated U.S. entity. There are several ways to access that liquidity as a U.S. customer. The simplest is an OTC desk. So the OTC desks, they have structured themselves to be able to onboard globally, even if they're a U.S. regulated entity. And they are effectively passing through that liquidity to you, of course, with a price. For institutions, that's sufficient. Basically, if you trade with a Jump or a Cumberland or any of the names I named, you're getting access to that foreign liquidity. I will say, we can only guess, but I would guess that more than 50% of liquidity today is Western regulated. The numbers that are published suggest Asia is 4 times bigger, but a lot of those numbers are fake volume. They're basically what exchanges will do is incentivize wash trading. The U.S. exchanges do this too in a legal sense. They'll do fee rebates, for example, where like I knew back when I was at SIG, we and every other market maker would market make Citigroup, and we would get paid by the exchange to provide incredibly, basically pick-em markets, artificially tight markets. In that case, the volume was real, but artificially incentivized. And the effect that has on a trader is you can have tremendous liquidity that's real trading, but the reality is it all goes away the minute there's a real bid or real offer. Basically, it's algos trading against each other back and forth for a penny. The minute real money comes in, all the algos see that and they try to front run it. So long story short, U.S. exchanges now have a very, very meaningful percentage of total liquidity. The CME futures alone are now probably 20% of global Bitcoin liquidity. So, that, and you can't get more trustworthy than that.
So what are some of the top trends you're following now that you expect to play out over the next few years?
At this point, my answers are somewhat boring in consensus. I'll give myself credit that my answers to this have been basically the same for 5 years, which is basically there's 3 use cases of cryptocurrency that are viable near term. And it's the same 3 from 5 years ago, which is store value digital gold. Bitcoin is the clear market leader in that. And my guess is that Bitcoin is likely to remain the clear market leader for the foreseeable future. Not saying it will forever, but I don't see that changing in the next 2 years. Number 2 is DeFi, decentralized finance. And DeFi really exploded in volume and size and adoption starting about 12 to 18 months ago, and it's been on a parabolic trajectory since. DeFi is taking traditional finance, the basic functions of exchange, borrowing, and lending, and rendering it in decentralized form where you're not beholden to a bank approving you, you're not beholden to bank hours, and there's global accessibility. Same on the exchange side, right? Part of the adoption recently has been driven by the horrible experiences millennials have had with traditional finance. So millennials were trading GameStop on Robinhood, and suddenly they're like, wait, why am I being told which stocks I'm allowed to trade? That's crazy. Why am I being told what I can trade and when, right? So decentralized finance is that. No one can tell you when and what you're allowed to trade. And that's not to say there isn't regulation, but certainly, at least currently, the regulation is extremely more limited, is much more limited as regulators figure out what they want to do and how they want to regulate the space. And 2, much of crypto is semi-centralized. So a lot of projects that claim to be centralized actually have a for-profit company behind them, an identifiable team. Some of these projects have issued securities that should have been registered and they face regulatory action. But there are decentralized protocols that have been released by anonymous teams that are truly not controlled by anyone, that are simply out there, that are deployed, that no one controls. Truly, no one controls them. And so regulators have no one to take to court. There is no entity to sue. There is no person to put in jail. It's just a protocol. Regulators can basically tell individuals what they can and can't do, but there's kind of no practical way, short of the SEC trying to go after individual retail traders for, hey, you weren't allowed to trade $100 of this on this decentralized exchange. Short of that, it's kind of a Wild West. The other big one that's happening right now is NFTs. In practice, the areas of adoption that we're seeing for this right now are collectibles. So NBA Top Shot is a project selling NBA collectibles. They've done more than $300 million in sales in the last 4 months. They are a meaningful source of revenue for the NBA, and every league is taking notice. Every IP owner is taking notice. So, $300 million in sales, the NHL is saying, why aren't we getting a piece of that? The NFL, every soccer league around the world, every IP owner in the sports world, the UFC, everyone is looking into this. And within a year, a long list of the entities I just named will be offering NFTs because the demand is proven, the product market fit is proven. Why wouldn't they basically monetize their IP by a very easy, efficient distribution path? On the music side, the DJ Blau did 11.5 million of NFT sales in a single day. That's at a scale that's interesting to every musician around the world. Beyonce, Taylor Swift, 11.5 million in sales in a day is interesting to everyone. On the art side, Beeple sold a work of art for $70 million with Christie's. 70 million. That's interesting to the Andy Warhol Foundation. That's interesting to Damien Hirst. So every artist and artist estate in the world is now looking at this. And all of the NFT platforms are getting massive inbounds. This is an hypothetical. They're getting inbounds from people like the Warhol estate. They're getting inbounds from people like Steve Aoki. So NFTs, I'm very confident, will be 100x in total size in 3 years. That doesn't mean the individual assets will go up 100x. Right? This is horizontal growth. This is more NFTs being offered and sold and purchased. It doesn't mean that the existing NFTs will meaningfully appreciate.
Yeah, because they've gotten a lot of attention lately, a lot of public attention lately. And that was going to be one of my trend or fad questions to you is the attention and the returns that we've seen, that we've heard about. It comes off a little faddish, but I'm sure there's some real technology there, some real application and solutions that it offers.
It is faddish in the sense that there's a lot of speculation and hype. If I had to guess, I would guess that the existing set of NFTs are worth less than 2 years. A lot of people are surprised by this because they're like, why would someone spend $1 million for a picture image that I can freely copy? The reality is that today, and this has changed over the last 20 years, today, knockoffs are of a quality that are indistinguishable from the real thing, even by experts, with some exceptions. So for example, every year, Christie's and Sotheby's accidentally auction off works by artists like Picasso that are forgeries. That's after their experts examine them under a microscope. So we're not talking about a consumer can't tell the difference. We're talking about a team of experts being paid mightily to ensure authenticity are often getting fooled. And that's true of fine art. It's true of wine. There's a Netflix documentary about a wine forger who was selling $10,000 bottles of wine that were forged. Same on Rolexes. I just saw a YouTube clip where a watch expert is comparing a recent knockoff. Obviously, we've all seen bad knockoffs. We've all seen Chinatown knockoffs of terrible merchandise, but there are quality knockoffs now that are indistinguishable. So I, as a consumer, if I'm going to buy a Rolex or a Gucci bag or a Picasso, I know that I can't tell the difference. I know that whoever I'm trying to show off for can't tell the difference. And yet, we as humans value authenticity. We value scarcity. That's just so built into our bones that we even if I can't tell the difference, I care that I'm getting the real thing. I care that I'm getting the authentic Rolex or the Picasso that was painted by Picasso, right? I care about that, even if I can't tell the difference visually. NFTs are just the natural extension of that into a digital world. NFTs are for IP what email was for communication, which is bringing this thing into a internet native world.
So we do a speed round called Trend or Fad. I'm going to mention a few different topics and get your quick take on Trend or Fad. Thematic investing, Trend or Fad.
Trend.
Value stocks, Trend or Fad.
I can't give a concise answer because value is being like so hotly debated. I follow Cliff Asness on Twitter and was a reader of his work from AQR and his work back when he was an academic. And it's I actually did a lot of risk premium work at University of Chicago, and I'm very in the weeds on this, and I don't have an opinion. I'm not sure how to think about it, and neither do people like AQR, given their results over the last decade, frankly. Cliff's brilliant, by the way. They're brilliant people, but clearly the old consensus on risk premia at least has not been working for a decade.
And then finally, connected home fitness, trend or fad?
I'm going to guess trend. I don't know.
Some people will stick with it. I've already stopped riding my bike indoors, but
it's probably a trend. I'm like, this is like one of those cases where like I'm personally skeptical of a lot of this stuff, but like again, like I was skeptical of Rolex watches and Gucci bags like from birth. I personally have not bought NFTs as investments, but I have bet on NFTs as a theme that will persist, if that makes sense. So same with home fitness, like I see the value there. It probably, I don't know what scale, like COVID obviously juiced things. There is probably something, it's not going to go away. Is it going to be a growth area? Or is it going to partially replace gyms in 5 years? I don't know.
Well, this has been great. I really appreciate your time and your insights. What's the best way for people to follow you and connect with you?
The honest answer is probably Twitter. I'm at Ari Paul on Twitter, and anytime I do a podcast or interview or write an essay that gets published somewhere, I end up linking to it there. So that's probably a good forum.
Fantastic. Ari, thank you so much.
Thank you.
And thank you for tuning in to another episode of Trends with Benefits.